Welcome to the Deep Dive. Today we are focusing on one of the most volatile defense stories out there right now.
You are.
We're taking a hard look at Red Cat Holdings' Q3 2025 earnings call. It dropped after the market closed on November 13th, and it caused quite a stir.
It really did. So our mission today is pretty clear. We need to distill the key financials, get the operational story they're telling, which is, incredibly bullish, and then trying to figure out why that story clashes so hard with the guidance reset that just cratered the stock.
Right. It's that divergence, the story versus the reality check from the market.
Exactly.
Okay, let's just jump right in because the headline numbers were, completely bipolar. You had this explosive growth on one side,
Right.
And then a stunning failure on profitability on the other.
A complete miss. Let's start with the good news, the top line. Revenue hit $9.65 million.
And just for context, that's up, 200% sequentially?
200%, quarter over quarter. And get this, up 646% year over year. It's massive. It proves they can actually deliver on these big contracts they've been talking about.
So that sounds like a home run, a dream quarter for a growth stock. Why on earth did the stock immediately crash?
Well, the dream became a bit of a nightmare when you looked just one line down. See that $9.65 million? It beat the lower end consensus of about $8.5 million.
Okay.
But it missed some of the higher expectations, which were closer to $14.1 million. But, the real poison pill here was the GAAP EPS.
The earnings per share?
It came in at negative 16 cents. Yeah. That was a crippling, something like a 78% negative surprise compared to the consensus, which was around negative 9 cents.
Wow. So investors just blew right past the top line growth and honed in on the cash burn, the fact that they're losing money way faster than anyone expected.
That's it. It explains the immediate, really negative reaction. But there was one piece of good news on the balance sheet that we can't ignore. Management pointed to a really strong liquidity position. They have $212.5 million in cash and accounts receivable. And they made a point of saying, this gets rid of any prior going concern worries.
And for anyone who doesn't live and breathe this stuff, what does going concern actually mean?
It's basically market shorthand. It's a way of saying you have enough cash to stay in business for the foreseeable future. A going concern warning is an auditor saying they have serious doubts you can stay afloat.
So that $212 million is critical. It's the war chest that's funding this whole aggressive expansion.
It is, yeah.
All right, let's move into the deep dive on their strategy because management sounded almost defiant on the call, despite the miss.
They did. Their whole story is built around one thing, capacity. The CEO even used this really strong phrase. He said, factories are the moat for defense.
Factories are the moat. Okay.
And that record revenue we saw, it was almost all driven by deliveries for the U.S. Army Short-Range Reconnaissance Program, the SRR Tranche 2.
Right. And that SRR contract is growing, isn't it? The limited rate production part of it has expanded to, nearly $35 million now?
It has, which shows you the military's commitment is real. Yeah. And they are putting their money where their mouth is on that moat idea. They've doubled their manufacturing space in Salt Lake City and L.A.
And they're trying to scale up to how many drones a month?
The goal is 500 to 1,000 units per month by early 2026. This isn't garage-level production. They're aiming to be a volume player.
And it's not just drones anymore. They're making this huge strategic move into a new maritime division, Blue Ops, which is focused on uncrewed surface vessels, USVs.
And this is where the story gets kind of exponential. Yeah. They've already got a 155,000 square foot facility in Georgia that can build over 500 of these boats a year.
Wow.
And they actually quantified the potential. These USVs sell for between $750,000 and $1.5 million.
Each.
Management said on the call that selling, and I quote, only 200 boats could bring in $150 million in revenue.
Wait. So selling 200 boats gets them $150 million. They just reported a quarter of under $10 million.
See.
That single division could be, 4 or 5 times their entire current annual revenue run rate. That is a massive bet.
It's a huge bet, and it completely changes what this company is. And at the same time, they're moving up the tech ladder. Their F-Hang FPV drone just got added to the DoD's Blue UAS cleared list.
So what does that Blue UAS clearance actually signal?
It's the gold standard. It's the Department of Defense's stamp of approval. It means the drone is secure, it's interoperable, it's cyber sound, it's trusted for any U.S. military branch to just pick up and use immediately. It's a huge deal.
And they also talked about a big tech integration with Palantir.
Right, the VNAV software. They've been testing it on their Black Widow drones for operating in GPS-denied environments. And this is key because management thinks VNAV will boost the margins on the Black Widow.
Because they can sell high-value software on top of the hardware?
Exactly. They move from being just a hardware maker to a full systems integrator.
Okay, so we have the strong cash position, the factory is a moat strategy, the huge USV opportunity. Now we have to talk about the catastrophic flaw that overshadowed all of it.
The guidance.
The guidance reset. This is where the execution story just completely fell apart.
Yeah, this is the heart of why the market was so disappointed.
Yep.
And it was brutal. Management lowered the full year 2025 revenue guidance from a range of $80 to $120 million.
Whoa.
All the way down to $34.5 to $37.5 million.
That's cutting your guidance by more than half at the midpoint. You almost never see that. What was the reason they gave?
Two main things. First, they said there were unanticipated delays of about 6 or 7 weeks, government budget timing, change orders.
Yeah.
Frustrating, but, kind of normal for defense contracting.
Okay, but that doesn't explain a 50% cut. What was the other reason?
This was the more revealing one. It was a strategic choice to basically walk away from short-term revenue. They decided to move their FlightWave Edge 130 drone directly to a newer, more robust platform called Trison. They scrapped the interim model they were planning to sell this year. Management admitted that this decision cost them about $25 million in expected revenue for 2025.
So they essentially admitted the product they had planned to sell wasn't good enough for the long run?
That's what it suggests. They chose long-term product quality over hitting their numbers this year, which is, pretty big execution failure on the product planning side. And
all of these pivots and expansions cost money. The operating expenses must be running pretty hot.
Oh, they are. Q3 R&D spending was up 218% year over year. G&A up 124%. Over the last 9 months, their total operating cash outflow was a staggering $52.7 million.
So they are burning through that $212 million war chest very, very quickly.
They are. And that means profitability is still pretty far off. Gross margin did improve to about 7% this quarter.
Better than negative, I guess.
Right. But still wafer thin. They're guiding for it to hit 10% next quarter and then hopefully climb towards 20% by the end of 2026. But that requires perfect execution on scaling up.
Okay, let's shift to the investor context here. How does this stock's performance look next to its peers?
Well, this is what's so fascinating. The broader aerospace and defense sector has been on a tear, up over 32% in the last year.
Right.
Red Cat, meanwhile, is down 51% in the last month alone. It's a completely idiosyncratic move. The stock is being punished for its own specific execution issues.
So you have this huge gap. Management is selling this super bullish long-term story about contracts and capacity.
Right.
But the market is laser focused on the short-term reality. The EPS miss, the cash burn, and that huge guidance cut.
That divergence is the whole investment thesis right now. The market is saying, great story, but we don't trust you to deliver it. The reason institutions are still interested, though, is because of the potential catalysts on the horizon.
The biggest one being the full-rate production order, the FRP.
It's exactly the follow-on to the current SRR contract. Management hinted on the call that the size of that could be dramatically larger than what they have now.
And this is why, even after the stock crashed, an analyst at Needham kept a buy rating on it with a price target of, $16.58?
Which is more than 100% upside from where it was trading. They're making a bet that a huge FRP contract is a binary event that could just erase all these near-term concerns overnight.
That feels like a very risky bet, though, right? Given the operational headwinds we just laid out.
It is. And that's why the stock has implied volatility over 130%. It's the definition of a high-risk, high-reward defense story stock.
Okay, let's get to our favorite segment. This is not financial advice, but if we were to pitch an outrageous but plausible trade based on all this, what would it be?
All right, hear me out. Management just set an incredibly high bar for themselves in Q4. They're guiding for $20 to $23 million in revenue.
Which is more than double what they just did in Q3.
Right. It's a massive sequential jump after months of admitted delays. It requires a level of perfection they just haven't shown yet.
So you're thinking you bet against them hitting that number?
Sort of.
Yeah.
The pitch would be to take a cautious short position on the stock leading into the next quarter. You're betting that the execution issues and the cash burn will continue to weigh on the price.
But hold on. What if they suddenly announce that huge FRP contract or a big Blue Ops deal? That short position gets absolutely vaporized.
That's the risk, so you have to hedge it. You short the common stock, but at the same time, you buy out-of-the-money call options that expire, say, late in Q1 of 2026.
So the calls protect you from that massive upside shock.
Exactly. The hedge protects you against a huge contract announcement, while the short position bets that the market will continue to punish the near-term execution misses. It's a trade on the volatility itself.
So you're betting on disappointment, but with an insurance policy against the jackpot.
That's the idea. It's a way to play that gap between the story and the execution.
So to wrap this all up, our deep dive shows Red Cat is in this messy transition. It's moving from being a small drone company to a capital-intensive defense platform.
They've got the cash, the vision, the access to huge markets like USVs.
Yeah.
But investors are, for now, punishing the execution lag behind that story.
Yeah.
And punishing it severely.
Right. It's a compelling story, but it's facing a wall of skepticism. We have to say again, none of this is financial advice, just our impartial analysis for your education.
Yeah.
And we'll leave you with a final thought to chew on. Management believes the USV opportunity alone, where just 200 boats equals $150 million in revenue, could completely overshadow their drone business. So the question is, how quickly will the market start seeing this as a volatile story stock and start seeing it as a legitimate systems integrator with a diversified defense moat? That's what will define the next 18 months for this company.